All right, so it's noon according to my clock. So I just want to welcome everybody. Thank you. You guys are sort of the Lewis and Clark and pioneers. This is Hartford Financial Group's official first to go-to webinar, and we've been working, diligently with the COVID-19, and so I'm really excited to really branch into this. We've been using other software, GoToMeeting, but this is more geared towards the webinar format. First and foremost, I just hope everybody's safe and sound. Hope your family's safe and sound, both from a health standpoint, and then certainly a lot of folks that are out there struggling financially. So our thoughts and prayers are with them and you as you go through this. The thing that I'll really sort of kick this off is our disclosures and disclaimers and so on. So it's really important because a lot of times people don't understand all the relationships and who we are, what we are, and so on. So you know us as Hartford Financial Group. We work with a company called Cambridge Investment Research. They're considered a broker dealer, and the best way that I like to describe them is really there's 3,000 independent advisors that come together and they give us economies of scale. So they really help make sure keep our costs down. They keep a lot of the regulatory things of which we're not aware, they really sort of stay on top of. So we appreciate the relationship that we have with them. As you can see here, they're our broker dealer. We're not tied with them. Very similar, we're going to have Morgan Smith from Horizon Investments, and they too are not legally affiliated with Hartford Financial Group nor Cambridge. So it's my profound pleasure, really to introduce Morgan Smith, and really sort of explain to you guys the relationship that we have with Horizon Investments. Several years ago, one of their representatives had reached out to me, and they offered a new resource, which is called an outsourced CIO, or Chief Investment Officer. And the value on that is that if Hartford Financial Group was to try to do this alone, it's very, very high cost, because the credentialing that a person like Morgan has is one of the most robust in the industry. He is a chartered financial analyst, which means it was actually, go back to its genesis. Many of you have heard of Warren Buffett, and Warren Buffett's mentor was a guy named Benjamin Graham, and he was sort of the father of fundamental analysis. And so the chartered financial analyst, of which Morgan has, really came from Benjamin Graham, and it's a very difficult exam or credential to get. It takes you 3 years to do it. Very, hours and hours. Morgan can tell you how much he studied for that. So it's great for us to have Morgan be a part of our team informally to help us look at investments. Gives us perspective on the world that we don't have. So I'm really proud to have him as a part of our team. I consider him a friend. Some of the things I want you to know about Morgan is he's from upstate New York, and we joked about it yesterday. I know we've got a couple people on this call that are from that area. We would say he's not from New York City. That's on there. But the one thing is that prior to moving to Charlotte, Morgan worked for a private wealth management firm. He worked with foundations. And that's important for you to know, because it gives you a robust type of experience that he had. He's been in the shoes of what we're working with individual clients like many of you. The other part that I would include, just from a standpoint, many of you know how much I love baseball. So Morgan, sometimes our conversations can sort of deviate. He played college baseball at Binghamton University in New York. And his brother actually made it to the major leagues with the Toronto Blue Jays several years. And it was one of the cool things where Morgan and his whole family was able to see him do his major league debut at Camden Yards. So that's pretty cool. The other part is Morgan is engaged with his fiancee Danielle, and he's got a pit bull named Pork Chop. So I love that name. So without further ado, I am going to transfer control, so Morgan can really sort of give us a rundown.
Absolutely, thanks, Adam, and thank you everybody on the line for taking the time today. just to kind of start things off here and just give a depiction of kind of where we were at and where we are from a market and an economic standpoint, we did just want to start things off with where were we when we entered this year, and if we look back at January 2020. We were in a much different spot than we're at right now, right? When we're thinking about the risks that were in markets and risks that were in the economy, in 2019, we were looking at a trade war with China. We started to get some resolutions in regards to that. 2020, if we all can remember, is still an election year. And of course, the determination of who the candidates were going to be was a big point of discussion and understanding what the implications of that might be. And those were the primary risks in the market. From an economic standpoint, the U.S. consumer was in an excellent spot and about as healthy as it had been going back about 20 years. And if we look at what really happened in that first quarter of 2020 was just a multitude of events that really transformed where we're at right now. So, as we got into February, we started to see some volatility in oil markets. We certainly did get a little bit more clarity on the Democratic presidential candidate. But then, of course, you had the outbreak of COVID-19 internationally, and then it began to spread in the U.S. And we very, very quickly were put in this sort of quarantine mindset where the economy in the U.S. More or less shut down and came to an abrupt halt. And obviously that had implications, both from a macroeconomic standpoint as well as within stock markets, within fixed income markets. And we're certainly going to touch on all of that today. But I think it is important to understand just how quickly and drastically things have changed. Just working with Adam over the past few years and the team at Hartford certainly has been a pleasure. And we have been in constant contact and understanding what's going on and what the implications of, stimulus money coming through, of the Federal Reserve cutting rates, everything, that really plays a role in affecting your investments is really what we understand. We look to understand is just those risks in markets. So I just want to provide that as kind of a starting point of where we were, kind of entering 2020, and we can kind of get into the details of what's driving markets and the economy going forward.
Good. So, one of the things, Morgan, and there are a couple of things I didn't say in the precursor to this, is that we won't be going over specific investment recommendations, during this meeting, and just from a legal standpoint, we cannot do those types of things. We certainly recommend, if you have specific recommendations relative to your situation, is to talk to one of us or your specific advisor to make sure that you go through this. So, what I appreciate, everybody had sent in some questions that were top of mind for you, and what we're finding is that what's on top of mind for one person tends to be on top of mind for a lot of other folks as well. So thank you for sending in the question. So, Morgan, sort of to start this out, what was the lowest point of the market to date, and how far was it down? How much has it bounced back?
Yeah, absolutely. And if we look at that first quarter, the bottom, depending on which stock market you're looking at, but it was around March 23rd. As of now, of course, we certainly don't know what's going to happen going forward. But around March 23rd was generally the lows that we've seen in markets so far. And if you look at across different stock markets, generally the low point was down about 35 to 40%. Which was again a very significant sell-off, and what made this different than a lot of other sell-offs that we've witnessed historically was just the pace of it and how quickly it occurred. The market sold off in, depending on the market you're looking at, anywhere between 22, 24 trading days, and to fall 35% in such a swift amount of time. certainly was something we hadn't seen before. It was unprecedented. If you look at maybe peak to trough, so from the highs down to the lows in 2008 to 2009, that was almost a full year for that to occur. If anybody's aware of the 1987 flash crash, where we had a significant sell-off very quickly as well, that was over 70 trading days. So what we witnessed and what we experienced in the first quarter was about 3 times faster than that. So it was a very large sell-off, and of course we have had a decent bounce back ever since. So if you look at the year-to-date numbers as of the close yesterday, U.S. stock markets are now down a little over 10% so far this year. So they have bounced back pretty substantially off of those lows. There are different areas you can look at. International equities are still down, depending on which sector you're looking at, almost 20% so far this year. And so it hasn't been everything that's moved back up and bounced back consistently. But we would also note that while things did bounce back up quickly, a majority of those quick bounce back gains occurred kind of early April, late March, and over the past 3 weeks to a month, we've really just been kind of choppy and staying in this current market level. So we have certainly come off of those lows, which has been obviously very nice to see. But it certainly was a swift and significant sell-off that we did get through the end of March.
Thank you, Morgan. And I guess to sort of follow up with that, what is your team's prediction on the depth? I think it's a sort of a foregone conclusion. We're in a recession and moving within that. But what's the depth and length of the recession? And then one of the things that a lot of folks are hearing is just the things with recoveries, where you talk about a V, a U, a W, an L. Can you expound on those?
Yeah, absolutely. From a technical perspective, I think we'd all agree that we are certainly going to be in a recession once the official numbers do come out. The technical definition of a recession is 2 consecutive quarters of contraction or no growth. And we did get that first quarter number out that was down, and we certainly expect to see a large down quarter in this for the second quarter, just based on the shutdowns occurring really throughout April and most of May. So we certainly are in a economic recession here, and the depth and length of that, we still think is relatively undetermined, right? There's still a lot of uncertainties out there in the markets and how long this is going to persist. If you look at it on the positive side of things, we have a lot of companies that are focused exclusively on a treatment, on a vaccine, on getting testing, the requisite number of tests available. We're working on improving the capacity issues that we were seeing at hospitals. And all of those data points are things that can help to allow the economies to reopen and begin to kind of get back to functioning normal markets. And on the other side of things, though, is you have to look at is the idea that we might get that kind of second wave, right, where things maybe open up too quickly, or different areas of the country that maybe shouldn't have opened up yet have opened up, and you get a second surge. And when that happens, that would certainly increase the length and duration of that recession. So it's still, in our view, there's still quite a few uncertainties to truly determine how long this is going to last, because honestly, this is an unprecedented event and something we haven't seen before. And when we look at that recovery aspect, though, as things begin to open up, and Adam, to your point about a U recovery or a V recovery, and that's the idea of how long does it take the economy to get back to essentially where it was previously. And there's still a lot of unknowns there as well, right? As we begin to open up, everybody is doing it obviously in phases. You have service areas such as restaurants that are going to be working at half capacity for quite some time. You have consumers, so people that have maybe gone through a lot of their savings in this time period that are looking to maybe replenish those savings. At the same time, you know, you're going to have a lot of people with pent up demand, people that are sick of staying in their homes and are looking for an escape and are willing to take on some risk to go out and spend their money immediately. So there is a balance on both sides. It does appear that the stock market is looking at maybe a swift recovery, but at the same time, that's not always going to be the case, and we do think that there still are some risks that, you know, this recovery could take a little bit longer, and that's almost entirely dependent on, you know, how do we handle this avoiding a second wave of infection, and how do we get things kind of safe for everybody to go out and go back to their regular kind of activities and spending habits.
Yeah, thank you. And you know, one of the things I would share with you guys, you know, when in some of the conversations that we directly have with Verizon, and we participate in a number of their conference calls. Their chief investment officer for their firm is a gentleman by the name of Scott Ladner, and they also have economists and a very wide array of experiences on their team. One of the things that really sort of stood out to me was the difficulty. You know, oftentimes when you're dealing with financial professionals, they're trying to forecast, you know, and it's very similar to weather, you know, where you have meteorologists that are, you know, trying to predict what a hurricane is going to do is virtually impossible, because, hey, it's nature. There's a lot of good parallels to that, and you know, Morgan, can you share with us, you know, some of the things that you guys have shared with us on the difficulty of trying to follow models, just because of what's happened is there's been very few instances that are like this.
Yeah, absolutely, Adam. And let me see if I can pop this up on the screen here real quick. And let me know if you are able to see. Are you seeing the today's topic slide right now?
Yes.
Okay, perfect. So just to give an idea of what we're seeing in that idea, or to your point, Adam, of trying to look at you know, current models and get some predictions for the impact that it might have. You know, this chart right here, which is a little bit jumbled, but I think it tells a really cool story. And I don't know if cool is the right word, but it tells an interesting story. And these are GDP estimates, so the growth of the overall U.S. economy for the next 4 quarters throughout 2020. And the table, the really important line is that range row in that table on this page. And that's the idea, or the range is really just measuring what is the highest estimate for that quarter minus the lowest estimate for that quarter. With the idea that if there's a wide range, that means there's a little bit more uncertainty out there. And when we are typically looking at these GDP estimates, you know, it's maybe a half of 1% difference between the highest and the lowest. And what we're looking at here, this data is as of the end of March, is a range for the first quarter GDP of over 11%. And the second quarter GDP, it's over 56%, and then over 70% for the third and fourth quarters. When we look at information like that, or estimates by very smart people that range so significantly, that tells us that nobody really knows what the actual effect is going to be. You know, if you have a model that uses some specific data points, economic data points, such as U.S. jobless claims, and you know, this chart it looks at U.S. initial jobless claims going back 50 years. And the most recent data point makes the previous 50 years of data totally useless, right? You cannot, if your model was using this type of information to come up with an estimate for GDP growth, you know, in our view, that is just not you know, providing really a worthwhile estimate there. So yeah, Adam, to your point, there is still just a lot of uncertainty out there. So if you see people giving you definitive ideas of what GDP estimates are going to be in 2020, I would just understand that there's a lot of discrepancy there out there for what actually the impact is going to be.
Yeah, thank you, Morgan. You know, and what I would share with you on the call, and this, hey, we all crave certainty. We all want to know where it is, and we joke around, you know, and sometimes I think for people who are looking for us is, hey, do you have a crystal ball? The one thing that I can tell you in the years that I've been doing this, and uh, the markets are they're a very complex ecosystem, and it's not just one cause and one effect and all those types of things. And it's humbling because it brings you to your knees. Just when you think one thing's going to happen based on one set of data, something completely else happens. Now, it doesn't mean you don't try to predict and work, you know, but to think that you've got it all figured out, I would say it's sort of a fool's game to really sort of think along those lines. And that's the reason why you guys have heard diversification, all those types of things. You definitely need to, you know, because just equally to the upside, you know, things can surprise to the upside. If you would have gone back and probably asked myself and Morgan back at the, you know, sort of the middle of the March that the market would recover as quickly as it did, I was quite honestly very surprised. And where we're at right now, you know, it wouldn't be surprising either way that it would continue to go up or go down based on, you know, the things that you're seeing. And, you know, pretty much most of us are consumers of news that are out there, and very similar to, you can see with CDC and other areas, the challenge for them to predict, you know, how this whole virus is going to spread, or, you know, at the levels. You mean the challenges that you see with, you know, Dr. Fauci, Dr. Birx, and Birx, you know, with a lot of things that they're going through. So there's parallels across the board of what you're seeing, them trying to predict the pandemic, and then very similar to what's going on with the markets. Just to re-emphasize, you know, if you have any kind of specific questions that you have within here, you know, please, you know, email me in the chat. You can either do it privately or within the group. One of the things, there was a response that somebody had given me. You know, as Morgan and I were preparing for this, we didn't want to make this too wonkish and just a PowerPoint of a lot of charts and all those types of things. It's really sort of a dialogue. But if there are specific types of things you'd like to see, you know, let us know. And so our next stage, I think we've really talked about this, and maybe you can expound a little bit more. Do we believe there will be another substantial leg down in the market? Do I get out if I'm invested in stocks?
Yeah, no, I think that's a great question. And you know, the idea of another leg down kind of coincides with that same discussion around the uncertainty of, you know, how we could handle the spread of the virus and the testing and hospital capacity. Anything in that regard also is going to play a role in understanding, you know, if we're going to continue trending upwards from where we're at right now, or are we going to go kind of retest or fall back down to where we were at the end of March? And I think on both sides of the coin, you can see, you know, to the upside, you know, maybe a lot of this stimulus we're getting is going to basically curb a lot of those losses down at the bottom and let us get back to a functioning economy quicker. At the same time, you know, if you look at it on the other side of the coin, there certainly is still quite a bit unknown if, you know, if we do not get the testing capacity where it needs to be, if a lot of these treatments that are going through the requisite trials, if they begin to fail and not really show proof of concept, then at that point you'd expect markets to kind of fall down again. If you know, it's going to take a little bit longer than expected for companies to get back to business, that is, you know, again, still pretty uncertain. So, you know, we would say that, you know, at this point, it would not surprise us to see stock markets fall from here. It also, you know, markets will surprise you on the upside, Adam, right? To your point of where we were at the end of March, there will be very few people expecting such a swift bounce that we already got. So while there still is that unknown there, you know, in regards to your investments, you know, that's not necessarily a time right now where we would try to particularly time the market. To your point about being humble, Adam, I think we would all agree that we're not going to time the market perfectly. That is something that is not something anyone's going to do successfully on a very consistent basis. So we would remain invested in the appropriate portfolio that you're in. If you have risk mitigation type strategies built in, that makes perfect sense for this type of market environment. Things that aren't going to go down as swiftly as the rest of the market might be, but still give you participation if things bounce back up to the upside. So I would say it's kind of in that same realm of how long is the recovery going to take place? How long is this economic slowdown going to last? That kind of coincides as well with the stock market. There still is some uncertainty out there. We wouldn't be surprised to see markets take another step down. But at the same time, there could be some really positive news come out over the next few months that could kind of push things up a little bit quicker.
Thank you. Yeah. What we tend to see lately is that every time there seems to be a potential vaccine or something that dramatically causes the upside to the market. What I would share with our audience as from the financial planner perspective, one of the things, if there is a positive out of this, I think, and many of us across the board, it's given all of us time for reflection. And it's given our team a little bit more time to do research and so on. So one of the things that I would sort of share with you is that at Hartford Financial Group, we are, we're a comprehensive wealth management firm, and we're very, very focused on retirement income planning. For most people, why you save money in 401ks and IRAs and so on, which is the vast majority of people's wealth, is to use it for retirement income. Either it's, for some of us, it's the majority of our income. For others, it might just supplement it. But regardless, most people are sort of using it from a retirement income perspective. And one of the things that we're going to show to many of you as clients is a new software that we're using, some research that we've shown that really shows it, that when you're looking at your investments, when do you need money? And the portion that you have in stocks generally is not money that you're going to need for 10, 15, 20 years. And so that, that whole concept of, yes, it's down, and from the low, or from the high to the low, it was down over 30%. But the way we want you to really sort of think about this is that generally the portion that you have in stocks is for monies that you're not really going to be touching for 10 years and beyond for the most part. We'll talk a little bit later because we have some questions about bonds and cash and all those things that relate to, okay, well, what do I do in the interim? But thank you, Morgan, for sharing that. The next question is, what is different this time versus 2008? So 2008 was our most recent major bear market, and how does this stack up compared to that?
Yeah, no, it certainly has been a different experience. Obviously in both cases we had a recession and a sell-off in equity markets, but really what drove what happened in 2008 is very different than really what happened in the first quarter of 2020. I already made the point that the swiftness of the market sell-off was much quicker in the first quarter of this year relative to what happened in 2008 and 2009. But you also have to look at, the macroeconomic picture, right? How was the consumer doing entering 2008 and 2009? And in that case, I think, as we all know, both the consumer and companies were taking on a lot more debt, and were not in nearly as good of a financial position than they were entering 2020. In 2020, people have continued to actually pay down their debt over the past, say, 11 years, and have put themselves in a much better position than they were entering the Great Recession. So that obviously plays a large role in just the backdrop of the economy entering it. Secondly, what was different was in 2008 was really just a collapse of the financial system. And when that happens, you certainly just have a lot more issues from people getting access or feeling that they have access to cash from the banks, worrying about how is the overall stock market going to function when banks are close to bankruptcy. That is not the case that we are at now. A lot of the regulations that went into place following the Great Recession really shored up the quality of those banks and those financial institutions, so that they were not nearly as affected. Obviously, they're going to be affected when the economy shuts down, but they are still in a very high quality space where they can withstand an economic shutdown. So the overall system isn't going to kind of come to a grinding halt as we did have in 2008 and 2009. And then the other aspect of it is the stimulus measure, right? Where we did not have nearly as quick of stimulus being pumped into the economy in 2008 as we did in the first quarter of 2020. So the ability of the Federal Reserve and the U.S. Treasury to get money both from to consumers to businesses into markets was much quicker and much more substantial than what happened in 2008 and 2009. So while yes, we certainly had a recession in both cases, we had a large market sell-off in both. They are characteristically they were driven by very different things.
Yeah, and for many of you that read our correspondence, one of the things that I've shared with you is that my aunt was a history teacher, and so I loved, when I was growing up, I loved studying the Civil War and the Revolution and all those types of things. As I've really gotten into this career, it's actually become more sort of a financial historian, and so some of the leaders that I follow, they recommend, hey, if you're going to be in this field, you got to know financial history. And one of the things that somebody had said it, and I really liked it, and sort of goes along with what Morgan was talking about, was that sometimes when you're going through bear markets and recessions, some of them are caused by really challenges within the financial system. And in the way, when you look at banks and what is the role that banks play in our economy, somebody had said it, they're sort of the oil to our financial engine. And back in 2008, we had Bear Stearns and Lehman Brothers that were investment banks that were worried about bankruptcy, and then there was the worry that there was going to be a domino effect, that our whole, think about you driving your car, you don't put the oil in there, it's going to seize up your engine. And that's what people were really concerned about, was just that, hey, our whole economic engine wasn't going to exist. It's a little bit different, going in, like all the areas that Morgan was really talking about. At the preliminary stages, the banks and the consumer are in a much better place going into this than they were. So hopefully this doesn't continue to go out longer term, because then it could affect it. But at the preliminary stages, it doesn't appear like it was in 2008. Morgan, you talked a little bit about the stimulus and relief. The next two questions actually were about that. How do you see the phase 3 program and the $2.2 trillion relief package affecting the markets, and how do you see the $4 trillion Fed and Treasury programs affecting the markets?
Yeah, absolutely. So if we look at first the fiscal side of things, so the money that was brought in not only to or sent out not only to directly to consumers, but also small businesses and large businesses. A lot of the headlines, of course, have been about the $1,200 paychecks to individuals. The way we would see that is yes, that is stimulus, but that's more I would say income replacement than anything else for people that obviously aren't able to work at this point. So that obviously has played a significant role in giving people the requisite spending money that they can have, or that they need right now for just kind of getting by without work. But really what's very important about that, the fiscal stimulus, is that small business program. And that is primarily because there's a substantial, obviously, number of small businesses in the U.S. That really are responsible for trillions of dollars of economic output. And those smaller companies just naturally aren't equipped to withstand 2 to 3 months of no revenue, no sales, no business. these companies, they don't hold a lot of cash on hand because that's not really, they're not large enough to be able to just hold cash on hand. They need to continue to fund their business. So those companies, are certainly the most at risk right now, and they do employ quite a few Americans. So that is a very important aspect of that fiscal stimulus, and obviously we've maxed that out. I think twice at this point, the amount of money that has been allotted towards those small companies. But that really is one of the more important points. There was this data point that we came across that from earlier in the first quarter that somewhere around 50% of small businesses could only stand up 3 months without revenues, and at that point they would not be able to continue in business. So the money that is flowing to those companies is absolutely necessary in our eyes to keep them kind of afloat so they can come back when the economy turns back on. So I think that is probably the most important aspect on the fiscal side of things. On the other side of things, what a lot of what the Federal Reserve has done is bringing in or buying assets in income markets to make sure that markets are functioning correctly. This might get a little bit too in the weeds, but really just trying to provide what we would call as liquidity into those markets. So when there's not a lot of buyers and sellers on both sides, the Fed will come in to make sure that those markets are functioning correctly, and that helps to really alleviate some investor fears or concerns at that point. So, I think it all is obviously we have another proposal that was out there last night into this morning, so we don't think we're done with getting fiscal and monetary stimulus at this point. So we'd expect it to continue, but really the most important aspect to us at this point is making sure that money that goes into the hands of those smaller companies.
Thank you. And just sort of add on to this, Morgan, because we've had other folks talk about it with all this stimulus, the concern is adding to the national debt and in the future inflation. So what is the point of view that, in the short term it gets us through it, but then what's the long-term repercussions in your thoughts?
Yeah, that's a great question. Short term, I would absolutely agree that it, has been extremely helpful and in many regards necessary to keep the economy afloat during the shutdown. So short term, it has obviously been a very good thing. Long term, do not have the answer for that yet, but there are going to be some pretty significant, results or consequences for continuing to grow that debt at the national level. We've been saying this for a few years of the government just kind of printing money and not really cutting back spending, but continuing to grow that aspect of it, and that hasn't changed in quite some time. And to expect it to change at this point, I think wouldn't be realistic, right? And, we've kind of gotten into this phase of doing anything as possible to help people out at this point. So what the effect of that significant amount of debt is going to be is still a bit down the road in our eyes, and what that effect is actually going to be. And those consequences could be pretty significant down the line, but it's not going to be an immediate concern at this point. Really, just there's still a lot to know there. So I think that certainly is something we need to kind of keep an eye on. And there's a second part to that question I think I'm missing right now.
No, I think you answered that, and I guess some of the things that in the discussions we've had is that when people bring that type of conversation up, and it's not to minimize the deficit and the federal debt, but across the board it would be more of a concern if the United States alone was there. But across the board, Europe, Asia, virtually every economy is dealing with issues like this.
Yeah, absolutely, and they have been for quite some time. So it's not just the U.S. that is printing money like this, and one of the other effects that the effect of inflation on this, I think, is also something to kind of point out. And if you look at a country like Japan that has been in this almost disinflationary environment for going on 30 years at this point, and they're not shying away from any fiscal stimulus as well. In the U.S., if you think about is that to cause inflation to spike in the U.S., I think At this point, there's no indication that that is going to happen, immediately. It certainly can. I think you would also want to look at this fiscal stimulus in a little bit different way in this format, right? So typically, when the government is providing fiscal stimulus, they're giving money and putting money into the economy. That's to try to stimulate people to spend, give them a reason to want to spend their money, to take on, debt, to go buy a home. In this case of what we experienced, it was almost more income replacement for people that lost their jobs, and giving them the requisite money to, pay for groceries, pay for rent, any main bills, and not necessarily the same thing as encouraging people to go out and, get a new home or something along those lines. So it is a little bit different this time. And, you coincide that with a crash in oil prices, that is not going to move inflation upwards. So, at this point, we don't see that inflation rising significantly, but that obviously can change quickly depending on kind of what happens going forward.
Yeah, thanks for expounding on that. And it's important for our audience to know, the Federal Reserve has a dual mandate, and if you really sort of think about it, it's sort of like a seesaw. If they're trying to balance between inflation and unemployment. So they tend to work like a seesaw. When unemployment is down, then you're concerned about inflation, and vice versa. And because of that dramatic, if you think back to that chart that Morgan showed, the tendency when unemployment is much higher, the concerns about inflation don't tend to be as high, because now you have to balance people being out of work. So we, as we look across the board, we really don't see inflationary concerns on the horizon anytime soon. Sort of transition, Morgan, so there's questions about bonds, and so, and it fits into the sort of inflation and stimulus and all there. So the question, are bonds safe? Do bonds still make sense with low interest rates? Should I have bonds in my portfolios or just move to cash and CDs? So how would you respond to that?
Yeah, absolutely. I think that is a great question, and certainly something we saw in the first quarter was bonds with rates going down to essentially zero at this point, and the performance of fixed income wasn't tremendous in that first quarter, and people just looking at it and saying, okay, if rates are so low, do I really want an allocation to this? Do I want to invest in this? What's the point? And it's important to note that there are different aspects of fixed income markets that fixed income managers can invest in that help to produce income, as well as provide safety and diversification for your kind of core stock holdings, right? So within fixed income, there are U.S. Treasuries, which is the safest asset in the world. It pays a very low interest rate on that Treasury bond, but there's also different types of fixed income assets. There's corporate bonds, right, where companies like Apple will come out and they will issue a bond that pays a higher interest rate than the U.S. government, because they're taking on more risk by investing in a corporate bond. And if you look at fixed income markets like that, you are still getting a higher yield. Yes, you are taking on more risk than just a savings account, but over the long term, having exposure to bonds, different types of bonds, and run by fixed income managers that can selectively choose, what is attractive at this point, really provides a strong benefit for your overall portfolio, right? So when typically when stock prices go down, the prices of your bonds end up going up, or at least staying stable, and it provides a nice overall picture of kind of return for your overall portfolio. So we still think it does make sense. It certainly is worth evaluating fixed income markets, because we did see some issues there in the first quarter. The Federal Reserve did come in and shore up a lot of those issues, and the mechanics of those markets are working well now. So a lot of that has been taken care of, but would agree that yes, it's worth looking into to understand, why do I have fixed income? And it's to provide the diversification, to not move in line with just equity markets. It provides you income, so interest that is paid out to you in that portfolio standpoint. And it also is still liquid, right? When you have these fixed income managers and say a mutual fund, you know, you're taking advantage of that manager's ability to navigate that market, but you're also, you know, in those funds, in that fund structure, you're getting kind of a rolling investment into multiple bonds where you're diversifying that risk and not just sitting in a savings account that, you know, in some cases might not let you take out all your money right away, or just giving you a kind of stagnant return picture, whereas you can get the benefits of higher returns from that fixed income allocation.
Yeah, what we see is that a lot of times, I mean, everybody's really sort of aware that you need diversification in stocks. And hey, you might need large and mid and small cap stocks. You have international versus the United States. You have various sectors, technology versus energy and healthcare. What can happen sometimes is people can underappreciate diversification in bonds. So bonds as an asset class is extremely diverse. It's not just a one size fits all, like Morgan is saying. So moving along, Morgan, as we come up, you know, with 3/4 of the way through the hour, we're almost done there. What does the team use as triggers to start getting back into the market? Do you go in all at once or pieces of time? Assuming one has moved out of the market or maybe concerned about investing, how do you look at that?
Yeah, absolutely. And you know, the idea of moving out of the market and moving back in is a very difficult process, right? Because exiting the market typically is pretty easy, right? And you move out at the right time, that's great. You know, you moved out when equity markets were down 15 and they fell 35. The difficult part is trying to understand, when do I move back in, right? Because you do not know what's going to happen going forward. And if you get that decision wrong, you basically locked in losses on the downside from when you sold out. So it is a very difficult decision to make on, you know, when do you move in, when do you move out? You know, there's a couple schools of thought. Some would say, you know, if you just remain invested in your current portfolio, you know, over the long term, it should be able to rebound. And as long as you're in an appropriate portfolio that you can withstand based on your goals, that makes a lot of sense. If you have moved out, or if you have, say, cash that you have built up that you're looking to invest, I think one of the best ways to do so is this idea of what we would call systematically reinvesting, where you do it maybe on a calendar basis. You don't necessarily rely on market indicators. You don't try to time the bottom of the market or when is it going to go back down. You say, okay, you know, maybe on a monthly basis, I'm going to begin to reinvest money. You know, maybe do 1/3 of the money this month, 1/3 the next, 1/3 the next. And if you do it that way, you know, you have a process in place. You understand, hey, if markets skyrocket up from this point, I may miss out. But if they fall down significantly from here, at least I've limited some of those losses and I can withstand that kind of slower re-entry into markets. So doing it on a calendar-based approach and what we would call dollar cost averaging in, especially when uncertainty is so high, we think makes a lot of sense from a re-entry standpoint. If you know, you have cash on the sidelines, or you know, you have moved out and you maybe might went a little bit more conservative as things got a little crazy. So there's certainly a few ways around it, but we think probably the best way is to just make sure you have a plan in place and you stick to that plan and you understand, you know, the risks and the rewards of that plan, right?
Yeah, exactly. And what we would add, you know, from the financial planning perspective, and what we ask is, when people talk about, hey, is it a time to get in, you know, or out of the market? Well, one, at Hartford Financial Group, we really believe in behavioral finance, and it's really sort of the emotions, you know, behind it is understanding yourself. And the standpoint is that, hey, we can show you all the theory and we can show you what you know, what the textbook might say, but you know, if it's going to cause you to lose sleep at night, you know, then that's a legitimate factor that you have to factor in, and everybody's different, you know, with how we're emotionally going to respond to various things. With that being said, one of the things that I hope you're getting from Morgan and myself, it's impossible to time when the market bottom is going to be. So the question really that I would, when people have really sort of asked me those types of things, is to say, okay, when is your time horizon when you think you're going to need this money? And it's not just when am I going to, when you look at your whole pot, when I'm going to draw on my entire pot, it's that specific portion of it. And like we were talking about earlier, more than likely, the portion that you're going to invest in stock is for money that you're not going to use down the road. And it's really, really important. You need, I would make the case to you, you need stock in your portfolio for the vast majority of us because it's an inflation hedge. There's a slide that I usually show folks, and over the last 25 years, the cost of healthcare, housing, fuel, all those things are anywhere from 150 to 300% increase. And stocks are that hedge. And so it's important to not look at it, hey, if I invest now, is the market going to go down or up, in the short term? It's, here we are 2020, what are prices going to be 2030, 2035? That's where I would really have you think about, at that portion. So hopefully that makes sense. And like I said, we're working on tools to be able to show you those types of things of, hey, the money that you're looking at, you have cash and bonds, for the shorter term, that 5-10 year period. Stocks are much further out. Just a reminder again, if you have any questions, please ask. We have two more that folks had emailed in. What sector or sectors or segments of the stock market look at the most interesting to the team at this time? Something you're using, something you might use in the near future, something that you're avoiding for now?
Yeah, absolutely. I would say on a lot of this depends on the time frame you're looking at, right? So if you're looking at the next 3 to 6 months, and it's going to be a little bit of a different view than if you're looking out 5 years. On a shorter term basis, and really what we've seen so far this year is certainly strong outperformance by those technology companies and healthcare companies that typically are identified as growth stocks. And generally we've seen significant outperformance of those both on the downside and the upside from what we've seen so far, and that makes a lot of sense too, right? A lot of these tech companies, they're running low capital expenditure type businesses where they can still function very easily during an economic shutdown, and they're not reliant on brick and mortar stores for their sales. And those companies also have a lot of cash on hand, so they're able to withstand an economic shutdown significantly better than, say, a retailer or somebody that's more reliant on people going out and regularly shopping. So in that short-term time period, we still think that kind of that growth area, so think technology and healthcare are good places to be in because they're not as affected by the economic shutdown. And we'd probably still be avoiding, alongside those comments I made earlier about smaller companies, and really just with the uncertainty on the rebound for the economy, those smaller companies are probably going to be a little bit slower to bounce back. When they do bounce back, it'll be very quick and high to the upside. So, in that longer term picture, small cap equities might be a good, thought, just because they've sold off, a little bit more than larger companies. But on a shorter term basis, there's still just a lot of risk for those companies that, are financed primarily through debt and just don't have, the same cash on hand to withstand a few months, without any revenues coming in.
Yeah, exactly. And you can see, a lot of times we've all heard the axiom, buy low, sell high. Some of the industries that maybe travel or energy that have been really adversely affected, they are good bargains. But one of the things that you always want to really look at is what are the value of a stock largely is based on what you think the future earnings and revenue is going to be. And so the challenge that you can see sometimes is that, and this always goes back to the time horizon, presumably, energy and, travel will recover, how long is that going to take? So that's the thing that you have. If you got a longer time horizon, then you have some advantages.
Mm-hmm.
All right, Morgan. So we're in the home stretch, right now, and just one last question that we had, just within here. How does the team feel about global versus domestic investment opportunities at this time?
Yeah, absolutely. I'd say right now we would favor domestic stocks and bonds relative to international countries. There's a lot of caveats right now when you look at that, though, right? A lot of these international or foreign countries are a little bit further past the effects of the virus than we are in the U.S. But at the same time, we were in a better shape kind of going in. We have a stronger economy, and at the same time, to my point about the exposure to maybe technology companies, things like that, a majority of the technology companies are housed in the United States. So those companies that aren't necessarily as tied to the global economy, those ones are the ones that have been performing the best, and we think can withstand the length of the shutdown a little better. Whereas if you look at Europe, their overall economy is driven by banks, by auto companies, by travel. So those overall sectors or industries are just going to be naturally more affected by the global shutdown. So, for those reasons, we would prefer a U.S. Overweight. We still think it certainly makes sense to be globally diversified in total, because having that international component does allow you, exposure to a different part of the world that certainly has different growth aspects. So still think it makes sense to have a global picture, but more of a focus on United States equities at this point. Another thing we would mention is, in some of these emerging market countries that might be, have had a little bit more success and just very sharply shutting down their economies, and that really helped to stop the spread of the virus. Whereas in the U.S., where we're far more regional based, and it just basically didn't listen as well to shut things down, and that could extend the shutdown here. If you look at Europe, that is like the United States on steroids, right? Instead of different states that are going to roll open at different times, you're working with 20 to 30 different countries in the European Union that have to coincide. How do they open up their borders? How do they begin commerce between countries? And that uncertainty, we think, is still pretty large. So, for those reasons, we would still be a little bit more on the side of a U.S. overweight at this point.
Good. Well, hey, one final question, because we only have several minutes left. Just going there. How's Pork Chop doing today?
He's great. Surprisingly, Pork Chop is asleep right now and has slept through this entire webinar. He's 12 years old, and we think he's part pit bull and part sloth at this point. So he's doing good, though.
I'm sure he feels comfortable with his portfolio, so he's doing well. But so hey, this is a closeout. Morgan, we want to thank you so much for your time and being able to answer the questions. As I look at to our audience, we at Hartford Financial Group, as we talked about earlier, we just hope you continue to be safe, and your family and friends be out there. If you have any kind of specific questions or concerns, our mission is to serve, quite honestly, and be a part of your life to help you. We believe in life-centered planning, so we want this aspect of your life to be something that hey, you're in good hands. So if you have any questions, please reach out to me or other members of our team. We work very collaboratively with Morgan. So if there's any specific question that invariably you're like, man, I should have asked this, just reach out to us and we'll follow up with you. So thank you, Morgan and Horizon Investments. Thank you to everybody on this call, and just have a great day.
Awesome. Thank you.